I also want to thank all of our strategic partners. They're the people that make these events happen. I see some of you in the audience. Thank you, thank you. And speaking of our amazing strategic partners, this is all happening today because of our friends at Baker Tilly. They have been just an incredible partner over the years, and they put together the content for today. They are helping to fund this event, and we are thrilled. And I am now going to introduce you to John Dewalter from Baker Tilly, and he will get us started. Oh, one last thing. Sorry, John. You will see an FEI little piece on your desk or on your table. If you could, write down the name of someone you think would benefit from being a member of FEI. We would love that. Thank you. John?
Thanks, Brad. As Brad mentioned, Baker Tilly is a strategic sponsor of FEI, and speaking from a strategic sponsor perspective, as you saw up here, a lot of great content being offered by FEI. We're proud to support it, and happy to be here today with my colleague Sarah Leopold. Baker Tilly, we love numbers. We like helping people with problems, and we help people and our clients avoid problems. So, our services range from the traditional audit and tax work to getting a little deeper into numbers and analysis of numbers, supply chain and supply chain related decisions, risk mitigation, and a number of other items. Really hot topics right now for us. ESG is a big item. What enterprise risk management, internal controls is relevant, especially around what's happening in the banking industry right now. Data analysis, like I said, and Inflation Reduction Act. Those are a couple, key things that we've been working heavily on. But like I said, happy to have Sarah Leopold here today from our Minneapolis office. You'll find out pretty soon. Sarah is awesome at all things state matters, and so she's the first phone call I make when there's something coming up at a state level. Sarah's been with the firm 10 years and passionate about her work, so I'll let her speak to you more about that.
Thank you, John. All right, thank you. Perfect. So thank you for the opportunity to come and speak today. This is an area that for the last number of years we have gotten so many questions. The tides have somewhat changed, right? We've got employees working, remotely because telework in light of COVID. And COVID, I'd like to say, I shouldn't say this, is largely beyond us, but I'm not seeing that changing, right? We aren't seeing employers saying, hey, employees all need to kind of come back in. So there's still this large amount of telework that is occurring, as well as, having a hard time finding excellent candidates or resources. And so we've seen a number of clients, employers hiring in states, where they aren't physically located. So really excited. Again, as John said, I'm kind of a nerd when it comes to state and local. I've been doing it for about 20 years with revenue for about 10 years in policy before joining Baker Tilly. So really happy to be able to go over this. So if you guys have any questions, we will have some time for questions at the end. So if you're able to hold them that way, we can kind of keep on schedule a little bit. So, all right. So again, senior manager with Baker Tilly. What we're going to cover today, I'm going to talk about Nexus, just as a high level. It's really important to understand where your business may have Nexus and where you may have compliance requirements. So we'll touch on what establishes Nexus and what does that mean. Compliance requirements. So as an employer, if you have Nexus, or as a business, if you have Nexus in other states, what are the requirements, right, to make sure that you're in compliance with those state taxing authorities. And then we'll touch base on some exceptions to the normal requirements. And then lastly, I'm going to wrap it up with some planning and compliance strategies. So kind of overall, what are recommended next steps. All right, so Nexus. Nexus is basically a fancy word that means that you have a sufficient connection, whether it be economic or a physical connection with a state or a taxing authority, that they can require you to comply with their taxing laws, whether it be sales tax, income tax, non-income taxes, withholding taxes, what have you. Nexus is nothing new. It's been around from the inception of taxes, and it basically, the authority stems from the Constitution, due process, and the Commerce Clause, right? So there's a violation for states to impose an income tax on businesses that didn't have nexus or a sufficient connection with that state taxing authority. There's a number of cases that have helped establish, what states are able to impose as far as nexus, from a income tax, net worth taxes, gross receipts, sales tax, use tax, and what establishes nexus for different tax types is not the same. It's not uniform. So it's not uncommon for a business to have sales tax nexus and maybe not income tax nexus. Okay, so we'll kind of go over that and what that means. I know today the focus largely is where you have employees. So we'll talk about more physical presence nexus, because having an employee in a state generally will establish physical presence nexus. So some of those physical activities would be, visiting customers. So if you have travel, so if you've got an employee that's traveling into a state, that can establish nexus. If you've got an employee that's teleworking, so you hire that remote employee, that can establish nexus. Storage, and I see that there's a couple typos in here, so I apologize. Storage of goods, including consigned inventories. If you've got, your items that we see that more and more, right? You've got goods in a warehouse in another state, or you've got a fulfillment center in another state, that can also create nexus. Equipment, warranty work, and then what's changed more recently. Can you guys hear me okay in the back? I might just set this here. What's changed more recently then is economic nexus, right? So we've heard of Wayfair. We've heard of states imposing Brightline thresholds from an income tax, non-income tax standpoint. So those are kind of some of the newer changes that we've seen, and that's a continually evolving area, right? So most all states that have a sales tax have enacted an economic nexus, and we see more and more states with an income tax also imposing Brightline thresholds. I'm going to kind of skip over some of these, but again, you can kind of see income and franchise, Brightline thresholds. One thing I will note, because this does matter if you've got traveling employees, right, under the Where's Waldo umbrella, is Public Law 86272. So that basically provides protection for businesses that sell tangible goods if you have an employee going into another state for solicitation of orders only. So a lot of times we'll have clients that maybe are a service-based company, or they've got employees that are going into a state, or they have inventory in that state, or they have other activities, and they believe that they're covered under Public Law 86272 because they're selling tangible goods. And I want to caution that oftentimes is not the case. The activities either extend beyond what is protected activities under Public Law 86272, or if they're service-based, technology company or something like that, that does not apply. So just one thing to be cognizant of. I'm going to touch on this. Most of these have expired, but when we first saw COVID and the declaration of emergency orders across all of the states and stay-at-home orders, what have you, many states came out and said, we won't change how an employer is required to withhold or require you to get registered because your employee is now across the state line working. So here we are in Minnesota. Let's say you had a handful of employees that live in Wisconsin that normally drove into Minnesota for work. Now during COVID, they were working from home in Wisconsin. Many states said, we won't require you to get registered and withhold and kind of make changes, employer, while this emergency order is in place. So a number of states had these exceptions. I will say these have largely, they've expired, right? Because those emergency orders have expired. But it was, if we're looking back at earlier compliance, non-compliance, if you're trying to wrap your brain around big picture, what did we do? Did we do it right? It's important to note that there were some exceptions for businesses in kind of the heat of COVID when everyone was working remotely. All right, so compliance requirements. What I'm going to touch on is wage withholding and unemployment insurance. Now there are quite a bit more, and you will hear about that in the second portion of today's presentation. But if you have employees working in different states, a huge area of noncompliance that we get a lot of questions on is, where do you report those wages, right? So if we're a Minnesota-based company and we hire an employee in Colorado because they're an excellent candidate, or maybe Susie used to work in Minnesota, but during COVID she moved to Georgia because she was working entirely remotely. Maybe she told you, maybe she didn't. Wage withholding is required in general based on where that employee is being compensated for the services that they are providing. So if that employee moved to Georgia as an employer, you are required to report those wages to Georgia and withhold on them. Now maybe Susie is still a Minnesota resident and she just went down there for 3 months because she could. I thought about it, right? During COVID. You still would have a wage withholding requirement. Some states have minimum thresholds upon which withholding is required, so you don't have to withhold wage withholding from that employee until they've worked here for X number of days, or unless you anticipate paying Susie X amount in a calendar year. So there are some minimum thresholds. I will note most states say day one. Do most businesses do that on day one? No. So at the end we're going to talk about planning and compliance and some recommendations and what we largely see businesses do. But it's important to note that when you have an employee that's either traveling for a month or 2 months or 2 weeks, or an employee that has moved and relocated to another state, that wage withholding needs to mirror where that employee is physically being compensated for the services that they're providing. Okay, and we get these questions a lot, like, what if Bob wants to, move and help take care of his mom in Florida for 6 months? Is that okay? And there's different factors to kind of consider. So one important thing to think about, again, I'm going to touch on this in the compliance and planning, is it's not just wage withholding, right? So when you have an employee, we touch base on physical presence nexus for different tax types. So when Susie moved to Georgia, your business now needs to consider, what other taxes are we subject to in Georgia? Do we have receipts sourced to Georgia? We've never filed an income tax return in Georgia before, but maybe we should have when Susie moved. Maybe as of that year we should have. Do we sell goods? Does sales tax apply to our services or our goods in Georgia? So if we have customers in Georgia, we never really worried about it before, we need to be thinking about that, right? So in addition to wage withholding, it's important to think about, what other compliance considerations come into play because of that employee moving. The really tricky part is maybe you didn't know that she moved. Maybe you didn't find out she moved until you had a Teams meeting or a Zoom meeting company-wide, and Susie's got palm trees in the background, right? And she didn't before, and we ignorance sometimes is bliss, but we've seen states get more and more aggressive. So there are some states that don't have wage withholding, but largely, most states do have wage withholding. Another key thing is, then Susie moves back, right? So then her withholding switches back to Minnesota. Another key area is explaining to your employees or putting some policies out there so that they know, well, if you withhold from Georgia, Susie, you're going to probably have to file in Georgia, right? And then she'll get a credit for her taxes paid when she files in Minnesota. But as you're withholding from different states, or you've got employees that travel periodically, maybe they're here for a month or 2 months and here for a month or 2 months, it adds complexity to their income tax filing requirements also. So some employers say, hey, that's not a problem. Joe chooses to move around and work somewhere different every 3 months, that's Joe's choice. But if it's business-related travel, or it's also sometimes just important to make that information available to those employees. So wage withholding. We have seen clients that have employees that travel for work into other states, and they have just made it a practice to withhold and report the wages based on that employee's state of residence. What happens under audit, so my most recent one was a Minnesota company that sent employees into Wisconsin to work and only withheld Minnesota. Wisconsin caught wind of it. Hey, usually by an audit or what have you, hey, you came, you did all these services, you didn't have payroll. How did you perform all these services? The business got audited by Wisconsin. Wisconsin did a full review of the projects, books, records, time reports, right, for the work, and assessed the employer the amount of wage withholding that they should have withheld from those employees that were physically working in Wisconsin. So the employer had to pay the wage withholding. If they wanted to recoup that, this employer couldn't eat that amount. They had to correct all those employees' W-2s, and there was like 10 to 12 involved, correct their W-2s, instruct the employees that they needed to amend their Minnesota filing, file in Wisconsin, and reimburse the business. They ended up paying for the cost to do all of that because it was less than the amount of withholding. But it's not just a, hey, deal with the employee. You know, it is an expense, an assessment for failing to properly withhold on the employer. We've also seen it in light of COVID, because while I said earlier, ignorance is bliss, some states don't buy that, right? It's you know, a disregard, it's negligence to not know where your employees are physically working. And so if the state knows that so-and-so is working in their state and you don't have withholding and they have wage withholding, you could be on the hook for the potential of withholding that should have been withheld on those wages. So not something to disregard. It can add up, and the fix for it can get a little messy. The next is unemployment insurance. I'm not expecting a call. I'm just trying to make sure I stay on task here with time. So the next is unemployment insurance. So while wage withholding can be collected from and reported to multiple states for one employee, right, if they're working in more than one state, unemployment insurance is typically reported to one state, and that's where that employee's primary work location is. If that employee does not have a primary work location because they are working in multiple locations, then we look at the Department of Labor's localization of work provision. So it's an older document, almost all states follow it, but it kind of has this hierarchy. So if you don't just have work in one state and you work in 2 states or 2 or more states, where is their primary work location or their base of operations? If they don't have a base of operations because they are entirely transient, where is their work directed from? So it's kind of this, you go down until the best option fits. So for the example of Susie moving to Georgia and coming back, if she went down to Georgia for a month or 2 months and she came back to Minnesota, you would be correct to continue to report those wages to Minnesota for unemployment insurance, because that's where Susie's base of operations is, that's where her work is directed from, and the move to Florida or Georgia was temporary, right? Now, if she intended to move permanently to Georgia and not return to Minnesota, then at the time that that move was determined to be permanent, you know, or not a temporary change, then you would need to get registered in Georgia for unemployment insurance and begin reporting Susie's earnings to Georgia. Okay, so again, typically wage withholding can be multiple states. Unemployment insurance is typically one state. The key thing on this too is at the time of, you know, when HR sits down because an employee is leaving or being let go or what have you, not leaving on their own accord, but if an employee is being let go or laid off or what have you, I have found it very prudent for my clients to let that employee know if they would qualify to file for unemployment insurance, which state to report it to or which state to file under. Because maybe Susie's been working in Georgia and that employer's been reporting the wages for unemployment insurance to Minnesota, or she went there temporarily or what have you. Well, if she files in Georgia, Georgia's going to send the business a notice and they're going to want to do an audit and figure out if the wages should have been reported to Georgia, not Minnesota. So it's important, again, we're going to touch base on, you know, compliance requirements, best practices. Obviously, we would want to have reported them to the right state, but it's really important to make sure that, you know, as part of the offboarding process, that the employee is made aware of where those wages have been reported for unemployment insurance. Yes?
So following that example, so you've got the employee who moved to Georgia on a temporary basis or something like that, and you're advising them, you know, that we withheld unemployment insurance in Minnesota, but now, you know, you're about to file for unemployment in the state of Minnesota, but how does Minnesota then deal with the issue that the person's got a Georgia address and all of those sorts of things? So, and it's not the company's problem,
Sure.
but I was just curious if you had any insights on that.
Yeah, and there might be an inquiry, right? So Minnesota, the economic development, right, is who kind of manages it. It's not uncommon to get an inquiry. Hey, can you share a little bit additional information? Here's some questions that we have to make sure that it was, being filed or claimed in the right state. But typically when you're reporting those earnings, they would be able to see that, it was here and Susie's moved since then or what have you. Yeah, but they actually are really great. I've worked with their team members a number of times. We had a lot of fraudulent claims, right, in light of COVID, and they're really pretty on top of it. Minnesota is. I will say some other states are not quite as on top of it, but Minnesota really is as far as those questions and actually getting a person to resolve it. All right, so some exceptions, reciprocity. So Minnesota has reciprocal agreements with only 2 states, Michigan and North Dakota. Wisconsin, we used to, we do not anymore. But basically, if you have an employee that is a resident of one of these states and is working in Minnesota, you wouldn't be required to withhold as long as you had the proper documentation. It's not an automatic, so you would need to make sure that you got the proper documentation each year from those employees so that you wouldn't need to withhold Minnesota taxes from those employees. Similarly, most states have reciprocal agreements with other states. So if we're not talking just Minnesota, and I made this more Minnesota, but if you've got employees that are based in another state and working but are residents of a different state, it's important to first check and see if there are reciprocal agreements between the states. It cuts down on that employee having to file income tax returns in additional states. And as an employer, if it's only that one employee working in the other state, cuts down on the employer needing to register for a withholding account and collect and report the withholding tax for that state. Okay, so planning and compliance strategies to wrap my portion up here. So again, nexus review. I can't stress this enough. It's really important, at least annually, if not more often, that your business is taking an inventory of where you have nexus, right? And that involves looking at where you have physical employees, where you may have inventory, where you may have employees traveling to, where you go for trade shows, right? Do you send folks for trade shows? Do you present at trade shows or have a booth? And what are your sales by state, right? So all of those things are areas that can establish nexus. And it's important because if you have an employee, Susie moves to Georgia and you get registered for wage withholding, but maybe you were subject to income tax also, and you didn't comply with income tax, well, now they know you're there because you've registered with the Department of Revenue for a wage withholding account, and it's only a matter of time before you likely get a nexus questionnaire saying, hey, fill out these 8 pages. We want to know your top customers, your sales for the last 3 years, any travel, any, you name it. And at that point, it's kind of more of a gotcha situation, right? So before you get registered and move into a state, it's important to consider what other tax types, right? Focus on your high activity states and localities. Sometimes it can be overwhelming. I had a call yesterday with a client that has nexus in almost every single state. And I'm like, let's just tier it out. Let's chunk it out. Let's take the top 10 states where you've got exposure or sales on the next 10 states and kind of, focus on getting into compliance. Is better than putting your head in the sand because it's too much. You see that sometimes. But, where do you have high amounts of sales? Where do you have employees? Where are you registered for other tax accounts? Where are you filing income tax? Because those are states where you're already on their radar and your exposure risk is a little bit higher. Okay, quantifying exposure for prior tax penalties and interest is also key. If you have nexus in a state and you haven't been in compliance, you have the opportunity at that point to do a voluntary disclosure agreement in exchange for a limited look-back period, typically, and a waiver of penalties. If you don't do that and they send you the gotcha letter, they can go back as far as they want because there was no statute of limitations if you weren't in compliance. So as part of the nexus analysis, it's important to quantify potential exposure. Hey, your business established nexus back in 2020 when your employees moved to these other states, and here we are in 2023. Here's the amount of income tax you could have been subject to. Here's the amount of withholding tax. And oh, by the way, your sales are taxable too. Here's the amount of sales tax. Right? And if it's $3,000, you might say, Sarah, I'm not going to lose sleep over $3,000. Let's focus on the bigger states. You might say, hey, it's $30,000. Let's clean that up. We're either going to have a due diligence or investments, or our audit committee is going to point this out. We're going to have to book a liability. Let's clean this. At that point, we would have the options of either registering, filing retroactively, doing a voluntary disclosure agreement, or what have you. But we've got some options to get the business into compliance and some benefits. Make sure you keep all records to support exceptions. So often we see states publish guidance, and maybe it's a fact sheet. Everybody knows Minnesota used to have awesome fact sheets. Poof, they've been gone. They've been replaced with these like online guides, right? Which are largely helpful, but it's a little trickier to like document that, highlight it. They're not quite as detailed as they used to be. So if you have anything that supports the position that you're taking, print it to PDF. Don't kill trees, right? But save it, tuck it in your files somewhere to support your position. And again, considering other applicable taxes before registering for accounts. And purposes of time, again, we'll have time at the end for questions, and I'll also stick around after if you guys have questions. But just really important, think big picture. Having employees in other states, whether it be permanently, temporarily, what have you, is something that, we've helped clients set some HR policies around. Here's our handbook. If you're going to work in another state for more than 14 days or travel or what have you, you have to get it approved. Or setting some different guidelines. That way, if you do get audited by a state agency, we have some support to say that the business exercised its due diligence in understanding where these employees were and maintaining compliance, right? So it's really important to be able to document that you took necessary steps and efforts instead of just kind of ignoring it, right? So, one more really quick question.
Yeah, I was going to ask, Minnesota has got a budget surplus right now as a state, so perhaps they're less aggressive about going to other states to get, the information from. And compliance you have to care about all. For you is, which states do you see that are most aggressive because they're recognizing this as a revenue opportunity to help fill their state coffers? Which states are most aggressive?
Yeah, and the aggressive states are kind of the same. We see California, Washington, Texas, New York, really kind of some of those states that are very aggressive. But Texas not so much with employment because they don't have wage withholding, but other tax types certainly. Most clients really get picked up on audit. That's how they discover you've got someone working here that we maybe didn't know, unless you get registered. And then they're like, hey, where's the other taxes? So, yeah, great question. Okay, so I am going to turn it over to Scott Blake. He is an attorney with Felhaber Larson. He's been there for about 10 years. We chatted a little bit before, and he has quite a bit of experience in the payroll-related compliance. So I'll turn it over.
Thank you, Sarah.
Yeah, thanks, Scott.
So Sarah said, my name is Scott Blake. I'm an attorney at Felhaber Larson. Focus on employment law and primarily advise employers on a host of HR and compliance issues. And so obviously over the last couple of years, with the expansion of remote work, a lot more things that should be on leaders' sort of checklist to make sure that we're compliant with all laws. And so today I'm going to talk about, first off, sort of some best practices, so how to manage it. And obviously, like when COVID came out, I think a lot of employers just let their employers do whatever, and we're trying to figure it out sort of after the fact. But now when we're sort of coming out of COVID, I think it's a good plan to make sure that you have a thought out policy, practice, and decision-making process when you're making these remote work decisions. And then I'm going to talk about some laws that should be on your radars that vary by jurisdiction. So if you were to take, like if you find someone, if you're doing a nexus review and you're figuring out where all your employees are, what are some checklist items that you can go through to say, okay, is this potential area of law an issue? Is this one? So you can figure out and make sure that you've got all your ducks in a row. So the first thing is deciding who can work remotely, right? And overall, it's good to have some type of process that you go through because there's a whole host of potential legal issues. Let's just say a discrimination claim. If you don't have consistency on who you allow to work remotely, right? So let's just say, for example, you require, let's just say in practice, you require older workers to come into the office but not younger. You would set forth that policy, but let's just say that's the unintended effect of how you manage your workforce. That's a potential age claim, obviously. And so it's good to have policies and practice that are thought through as you work through this. And so the first thing is, evaluate whether a position can be performed remotely or not, right? Obviously very dependent on the industry, if you're office-based or more production or service-based where you have to be in person. But evaluate whether the position can be performed remotely, and then can you manage the employee remotely? Is that effective? And then other things to consider: has the employee, how long they've been employed, and have there been performance issues in the past, right? And so obviously if there's performance issues with an employee, you can, as part of your consideration, say, look, you can't do remote work because we've tried to manage you remotely, but it's not working, so we need you to come back in the office. Other considerations: what does the employee need? So computer equipment, that type of thing. What would the employer provide versus the employee? And then what are the costs and risks associated with it? And so these are just factors that should guide sort of your decision-making process. And then the other thing is who decides, right? And so is it the individual employee determining whether they think that they can perform remotely? Or is it top-down for management? And I think the best practice is obviously to have something thought out to say, look, with respect to this group of employees, this is how our decision-making process is going to be made. And it's going to be, the leadership team, and certainly HR, making that. But again, the goal here is to have a consistent, thought-out process of determining who can be remote and who can't be remote. And then another thing that you should consider is having a remote work agreement or having some type of written policy that sets forth the expectations. I mean, a lot of time, and I saw this a lot in COVID, was, Johnny has been working remote, but I have no idea what he's doing, and I never talked to him, but I'm having performance issues, so now I want to fire him, right? But if you haven't managed that person actively or set forth the expectations of when someone's going to be, online and answering their phone and email, that type of thing, you can run into troubles there. So again, having some type of remote work agreement or a policy that sets forth all the expectations is a good idea. And then obviously periodically review it because everything's going to change. So what I'm going to move to here, which is more pertinent, what are the legal issues that are state-specific when you have employees working in different cities or states? And so we've got wage and hour issues, local law compliance, workers' comp, security issues, discrimination, and then the ADA that I want to run through here quickly. So the first thing are wage and hour issues. So obviously if you are an hourly employee, you have to track all your time accurately, right? And so when someone's working remotely, the lines obviously get blurred. So let's just say someone's 100% remote and they're an hourly worker. If they step away from their computer for 5 minutes, do they have to clock out or not? If they step away for 30 minutes or an hour to go somewhere, what are all the rules on when someone has to clock in? And an employer has, and it's like, let's just say, an easy example would be, you've got an employee who is hourly, and let's just say they sort of clock in standard 8 a.m. to 5 p.m. every day, but they're always answering emails in the evening, right? And the employer knows that and they see that. Let's just say, this employee's emailing you so they know that you're working, but they're not clocking that, right? So that's off the clock time potentially for that hourly employee. And to the extent you know that, and so the standard under the FLSA is actual or constructive knowledge. To the extent you know that but aren't paying the employee, that opens up the business to liability for those unpaid wages. So again, have clear record-keeping procedures for your employees. And then you have to pay attention to the meal and rest break issues. So under Minnesota law, if you work a full day, you get sufficient time for a lunch, which is typically interpreted as 30 minutes. And then if you work 4 hours, or every 4 hours worked, you should get like a restroom break, right? And so you need to make sure that employees, while they're working, are taking the appropriate breaks. And then you've got traveling time, right? And so normally, if you're working throughout the day, going to the office is not compensable travel time. And then, so the question is, are they fully remote? And then when are you requiring them to come to the office? And is that part of their regular commute, or is it something extra that would be compensable time? So another thing to be aware of. And then this is the sort of probably the thorniest issue is the local law compliance. And so every year, states and cities pass more and more laws that are specific to the jurisdiction. And so when you have an employees working remotely, now you have to think about, are they considered an employee under each of these statutes? And so like an easy example is the safe and sick time laws. So Minneapolis, St. Paul, Duluth, and Bloomington now have paid sick leave laws. And so if you perform any work within the city of Minneapolis, for example, if you work more than 80 hours in Minneapolis, then you are subject to the safe and sick time laws, and you have to accrue 1 hour of paid sick leave for every 30 hours worked. So if you're an employer based in Edina, pre-COVID with no one working remotely, you didn't have to worry about Minneapolis. But if you have a Minneapolis resident working remotely more than 80 hours a year, now you have to comply with that law and pay attention to it and make sure that you're accruing the sick leave according to the statute. So that, and then going outside of Minnesota, other states have paid sick leave too. So for example, California has it in a lot of other states. The other thing that is becoming more and more prevalent are wage disclosure laws. So California has it, Colorado, New York City, some cities in Ohio do. I think it's going to come to Minnesota probably over the next year or 2 years. I was surprised that it wasn't part of this current pending legislative session. But the wage disclosure laws, let's just take Colorado. So I recently had a client who hired someone, an accountant actually, who was going to work remotely in Colorado. Colorado recently passed a wage disclosure law. And so since this was their first Colorado employee, the statute doesn't apply. But the second you have that one employee in that state, then all of a sudden that triggers compliance with the law. And what it requires, in the case of Colorado, is that if you ever post a position that could potentially be performed remotely in Colorado, you have to, as part of the job description, list the salary range in the job posting. And then Colorado also has a requirement that says whenever there's a Colorado resident who's an employee and there's an open position at your organization for which that person is qualified, you have to give them notice, like a specific notice, that there's a position for which they could apply for and be promoted. And so we've got it, and so that's Colorado. California is a little bit different, and each state is a little bit, it has, sort of tweaks on what all these rules are with respect to wage disclosure and job posting. And so this is an issue to be aware of when you have people working remotely, that you may have to change how you post your positions and the information you have on them in the statute to comply with these statutes. Then we've got wage and hour laws, so like minimum wage, right? So Minnesota has a minimum wage. Minneapolis and St. Paul both have minimum wages depending on your size. But obviously other states and cities are going to have that, so you have to pay attention to that. And then the other thing to think about is the non-competes and the restrictive covenants that some of your employees may be subject to. There's some states that ban non-competes altogether, so like California bans them, except for in the sale of business context. Minnesota is considering legislation. North Dakota is very restrictive, but the states vary. And then most states will have some type of statute that says, if you work in our state, if you have an employee working in our state, you are subject to our non-compete laws. So you can't have like a choice of law provision that says, say in an employment agreement, between our employment agreement, Minnesota law governs even though you work in South Dakota. South Dakota has a statute that says we can't do that, so South Dakota law applies to whatever non-compete you're subject to. And again, so states have different variations as to the enforceability of non-competes. And so what happens is that, let's just say you have a Minnesota-based employee, you have a non-compete, you think that it is governed under Minnesota law, and then that employee goes and moves to California and works there for a year, and it's just not on your radar because you got a lot of things going on. Then all of a sudden an issue comes up where that person leaves and now you want to sue them for breaching their non-compete. All of a sudden the enforceability of that non-compete comes into question, right? So it's better to think about all this stuff proactively and then like create this checklist of all these various things, both on the HR side and on the tax side, and make sure that you've got everything lined up from a compliance and liability standpoint. The other thing to consider is workers' comp. Obviously we need workers' comp insurance, and then there's state-specific rules on that Sarah is well versed in. But then if someone trips and falls or injures themselves while they're working at home, is that covered under workers' comp, or is it just, you know, a household liability, right? And so OSHA came out with a standard to clarify this during COVID, just because it was becoming more of an issue. But the question is, if there's an injury, did it occur when the employee was performing work for pay? And then was it directly related to the performance of that work as opposed to your home environment, right? So if you trip over your dog as you're walking to go get some more coffee, I would say that's attributable to your home environment. But then let's say carpal tunnel is a pretty common workers' comp issue that I see coming up. If you have carpal tunnel from working from home because you don't have the right setup, or just because of the amount of computer use we have and age and everything, that would be more related to the performance of the work, right? So then there's OSHA reporting requirements. Obviously, you've got to do the Form 300s if there's a workplace injury. Then we've got cybersecurity issues. Just because of time, I'm going to run over these pretty quickly. But obviously, if we have people having computers, potentially printing off things, working on their home internet, that creates potential areas. You know, it increases your exposure to a potential cybersecurity breach. And depending on the industry that you're in, you know, there's certain reporting requirements. So, for example, if you're dealing with stuff protected by HIPAA, and there's a HIPAA breach, there's you know, very onerous reporting procedures that you have to follow. So you want to make sure that your IT is buttoned up on that, or, you know, financial information. If you've got customers' credit cards, social security number, that type of thing. If you have a breach on that, that creates a whole mess of notifications. So pay attention to those issues. And then discrimination and retaliation, I mentioned this at the top, but, you know, it's important to have a consistent, thought-out process, because if you treat people unfairly or unequally, or maybe you just don't have a reason or a clear policy, that creates potential liability, that you're treating different classes of people differently. And, you know, you may not be intentionally doing it, but someone may perceive it that way and sue you and say, hey, you're making all the old people come into work for whatever reason, right? And that's the pattern we see. And you know, they potentially sue you based on that. And then also we've got the ADA, right? So we've got employees who have disabilities. Pre-COVID, you know, a lot of employers required in-office work, and they said in-office work is an essential function of the position, right? It's a requirement of the job that you're in the office. Obviously, because of COVID, employees have been able to demonstrate, for the most part, and I'm thinking like office employees, that they can generally perform their job well remotely. So when you have someone who's covered by the ADA, so someone has a disability, and they say, look, I can't come into work because of my disability, so I want to work from home. As an employer, you have an obligation to engage in the interactive process. So essentially, can we find a reasonable accommodation to allow this person to do their job? And when viewing whether something's reasonable or not, there's a term undue hardship. And so what COVID has demonstrated is that it is likely not an undue hardship to allow someone to work remotely. And to have a policy that says, look, we need everyone in the office no matter what, and we don't make any exceptions to that, that argument doesn't hold as much weight now as it did maybe 4 or 5 years ago, because everyone's demonstrated, for the most part, that they can work remotely. So when you're dealing with disabilities, there's a little bit more nuance into whether remote work should be allowed or not. So with that, I'll turn it over to questions for both me and Sarah. Go for it.
Wages versus salary, hourly versus salary.
Mm-hmm.
Question. Kevin O'Leary came out and said, look, I've got people working remotely at home. Therefore, I expect them to be available 24/7. So the question then becomes salary versus hourly again. You know, his point being, he's got attorneys so he can do whatever he wants. But for the most real humans, if you've got people out of state working, you know, you have to figure out their salary versus hourly. And then what is the time of day? People answering emails at midnight, calls. Kevin O'Leary brought up, they call at 2 in the morning if they got a problem.
Yeah.
You know, so I mean, he can handle anything because he's got attorneys that can sue anybody they want. But for the regular humans, what does that look like?
Well, so regardless of remote work, you have to figure out, is this person exempt or non-exempt, right? And so the FLSA has the certain exemptions. So you've got the executive, the learned professional, the managerial one, right? And so you want to see, do they fit under that? And then if they are exempt, then their salary, and you can make them work whenever and however much you want, right? And then it's just an employee management as to, do we want all of our employees working at 2 in the morning, right? So you walk through, are they exempt or not? That's sort of step one, and that doesn't change because of remote work. You just have to make sure, do you fit those statutory exemptions? Then if you're not exempt, so if you're an hourly employee, and again, if you know your employees are working all the time, well, frankly, the employees technically an hourly employee has to clock in and out at any point in time in which they work, right? And so if I'm hourly, I'm clocking in to do that 2 a.m. phone call, I should record that time. And then if you don't, because some employees just don't want to go through the hassle or whatever it is, if you don't do that and the employer has constructive knowledge of it, then that becomes a potential point of liability for failure to pay them wages.
So the employer must track all this outside activity, is what it comes down to.
You have to exercise reasonable diligence. So you don't have to go through, the IRS has made it clear, you don't have to go through and audit when someone sends emails and track that to their time records. But I think if there's an established pattern that someone's always a night worker, but they never clock any time at work, then maybe then it's time to have a conversation with that employee.
A policy question. I think, sir, you mentioned earlier having a policy whereby you require your employees to notify you before they move.
Yeah.
Now, this now crosses a line, right? Because now your employees, you are deciding to move around, and that's their independent choice, but their movement around affects your business. If you're requiring them to provide you notice, are you then able to prevent them from staying employed if they move to certain locations? Let's say if it's an administrative burden on the organization, because it's going to create a new nexus, it's going to create new compliance, and they can move from city to city and create administrative chaos, right?
Yeah, and we've seen clients say, yeah, it's part of your, right, if you're going to be traveling elsewhere or moving, you need approval from your supervisor, what have you, X, Y, Z days in advance. We have seen clients say, no, you can't go to California. We don't want to file in California, or we don't, to your point, there's locals too. So I didn't touch on it, I know you touched on it with some different local minimum wage compliance requirements, et cetera. There's local wage withholding in some locations. And, Virginia, Pennsylvania, Colorado has occupational privilege taxes. So we have seen, businesses say and disallow the movement or the travel to those employees, And so from a legal standpoint, I'll turn it over to you if there's issues, kind of with that.
Generally speaking, I think you can say, look, you can have that policy that says, look, you have to tell us beforehand, and then it's subject to our approval, and you can say no. The one exception would be the last slide on the ADA thing. So say, for example, I had a client several years ago have an employee who had asthma or some type of respiratory thing, and they said, look, I have to be in a dry climate, so they wanted to go to Arizona. And so then the question is, today would be, can that person perform the essential functions of their job remotely from Arizona, and would that be a reasonable accommodation to accommodate, the respiratory issue? So subject to issues, some issue like that, I think broadly speaking, you can say, look, I'm a Minnesota employer, we're only in Minnesota, I really have no interest in employing someone from California because it opens up, sort of Pandora's box on compliance, and I'm not willing to do that.
And I think a lot of times employees don't know that. So we've helped do just even a one-sheeter that HR has available for employees so they understand if we have to withhold for other states, here's why we have to withhold for other states. As a business, here's our requirements and our responsibilities. Similarly, if you don't want to move, these are states we don't file in, we would be subject to, obviously you don't need to disclose all that, but a lot of times employees maybe not think, hey, I went to Florida for 3 months, what a big deal. They don't understand sometimes the repercussions that it has on the business. So having something more generic available is sometimes helpful. Oh, question up front here.
Oh, thank you. When the pandemic first hit, there was always the strain of no school, no daycare, and what that did to working parents, speaking of, late hours, where a lot of working parents were getting the kids to bed and then working till all hours of the morning. And one of my prior employers had a policy that said, no daycare, you must use PTO. That's not a work from home situation because you don't have, you're not able to focus because you don't have childcare. So now that things have settled down on that, are you seeing anything of that nature where there's a potential, how do you handle the no daycare, no school, not qualifying as working from home potentially because of the lack of ability to participate fully in the job while trying to do both, which is impossible for many?
Yeah. I see most employers being more flexible and like understanding of the situation if you have a snow day or whatever it is, or when you had kids having to quarantine and stuff like that. So I think most employers were a little bit more flexible, but if you wanted to be more hard on it, I mean, clearly with an hourly employee, you could say, look, clock in, clock out. If you have to go deal with your kids for an hour or whatever, you just clock out and then, please work your 8 hours or make up on the weekend or something like that. If you're a salary exempt employee, it becomes more difficult, but I think you could have a policy. You could have a policy that says, look, if you're salary exempt and you're taking more than, let's just say, like an hour away from work to deal with childcare, we want you to use PTO for that. I think that would be acceptable. But I think most people are more, I don't know. If you're salary exempt, it's more just get your job done whenever you can get it done.
Yeah, I was surprised that they had that policy for that
Like
reason.
I wouldn't, yeah.
Okay, I'm going to say it's 9 o'clock. If you have to leave, we understand that. Sarah and Scott have offered to stick around for questions and more conversation, but in case people have to leave, let's give them a round of applause. Thank you very much. And if you can stay, stay. If you have to leave, we understand. Thank you.
Yeah, go for it.
I'm sorry. On the topic of state withholdings, if you have a employee who's working remote, but they decide to work remote outside the U.S., would you just do withholdings for their state of residence, or what happens there?
That's a great question. We have experienced that. There are international things that come into play. So we typically loop in our international tax folks because if you have an employee working outside of the U.S., it can create international compliance requirements, registrations, etc. And so, now if that employee is a resident and has not, given up their domicile, so let's just stick with Minnesota, right? You traveled and you still have a home here, you have no intent of selling your home, and if, not intended to be permanent in nature, you could still withhold Minnesota because that employee will have to still file as a Minnesota resident and withhold. But there are international tax considerations. I had one client basically say, you're moving back to the U.S. or you won't work here anymore because it was another country. But there are international tax considerations that we would want to loop in international tax folks to make sure there weren't compliance requirements. Yeah, great question.
You had mentioned in the beginning that, I'm not a tax expert by any means, but you had mentioned in the beginning that there was COVID. There was a period of time when jurisdictions were giving kind of exemptions.
Yes.
What are you seeing now? I mean, was there any sort of bright line with jurisdictions? Is it 2022 that we should be most worried about, or 23 going forward?
Yeah, typically they were written that there was exceptions for employers as long as that declaration of state of emergency was in place. And those all had expiration dates that were written typically in session law, or by the powers of the governor, so they weren't, like in statute or rules or what have you. But there were time periods, those have all largely expired, they've expired. So, they came into effect, March, April of 2020, and they were set to expire at the end of the year, and maybe they extended it till July of, 2021 or what have you, but they've all expired. But it would have been in effect then for those periods of time. So if Susie had moved to Georgia, in Q4 of 2020 or Q3 of 2020, and there was those exceptions in place, well then, whew, we're okay for that period of time if there was an exception in place for that. But then if Susie continued to stay and that declaration of state of emergency expired, well, our free ticket expired, come July 1st or whenever that state of emergency was.
So for the
lifted.
most part, 2022 is pretty subject
Yes.
to,
Yes, they've been
concern.
long, yeah, expired. And then
or
I
could
will
be
note,
could be looked back at, right?
Yes, it absolutely could be looked back at, yeah. And I didn't go into too much detail, but some states like Pennsylvania, and we've seen more recent cases with Alabama also, exercise that convenience of the employer. And so if their base of operations is in Pennsylvania, but their employees now have moved elsewhere, those wages are still reportable to Pennsylvania unless that employee is working in a different state as a convenience of the employer. So let's say that they're a recruiter or something like that, and there's a reason for them. It's a benefit to the employer to have that employee located in Arizona. But if that employee can just do their job from Arizona and they've chosen to move to Arizona, Pennsylvania is going to say those wages are still taxable to Pennsylvania and reportable to Pennsylvania because they are there for the convenience of the employee. They could do their job and there's a place for them to work and there's no real benefit to the employer to have that person in Arizona. So they're still reportable to Pennsylvania. So you sometimes have this disconnect, right, of where the wages are reportable to. Now they probably still have to file in Arizona, or if it's another state that has an income tax, but they'd get largely a credit for the taxes that they were required to pay to Pennsylvania. At least some conflicting laws that come into play from state to state.
So sorry, on that, just curious, so like if I move to one of the states with like Texas with no income tax, or I'm going back and forth between them.
Yep.
So I file personal stuff here, but I file a personal income tax here and I file one for the 25% I work in Texas with no income tax. Would Minnesota still tax me on the 100% of that income
If you're
because
a
there's no
Minnesota
credit?
resident, they will
Because
tax
there's
you
no
on
credit
your
there.
full. Yeah. Yeah. And some states give you a credit for the wages that were earned in another state, and some states give you the credit for the actual taxes that you were paid. So if the tax rate's higher or lower, there can be some differences on how that plays out.
Sorry, one other unrelated question, but if you've got someone who's moving around a little bit, let's say their house is here, but they want to spend a few months at an Airbnb here, rent an apartment there, how actually do you see companies tracking this? Like, they're not changing their legal address, so.
Right. How we see it is that they
They
just
don't.
typically report it to wherever their state of residence is, unfortunately. Now, there's some clients we do have that are really on top of it. They've set some procedures. And once that employee is there for more than 2 weeks or 3 weeks or a month, right? So it's kind of a cost benefit, right, like analysis, right? Does the administrative cost exceed the exposure? You never want your administrative cost to get registered and file and start paying, your payroll provider to, what have you. Plug your ears.
Yeah.
But no, just so it is a balancing act. In a perfect world, if the state says day one you start withholding, day one you start withholding, right? But many of our clients look at, okay, and it depends on what are the earnings for that employee. If it's a highly compensated employee, that amount of wage withholding is going to be significantly more than if it's an intern that's traveling around, right? And we don't pay them that much or what have you. But we look at, and each company has to set their own policies of is it 2 weeks or is it 3 weeks, right? And if you're going to be there for more than X number of days, at that point we begin withholding. Or if we know you're going to be there for more than that number of days, then we do begin withholding on day one, right? Because if you send Bob to a conference for 5 days in, Pennsylvania, do you want to, or everybody, do you want to withhold from all of your employees for those 5 days, right? If the state says you should, you technically should. What's your exposure, right? Or do you continue to report it? So it is kind of you have to be okay with the exposure, right? So if we look at how much we pay and what's the withholding, and yeah, we should have withheld $200. Some employers will say, I'm not going to get registered and start filing for them for $200. We acknowledge that there's exposure there, and we're gonna go ahead and continue to withhold based on their state of residence or where they primarily work. So it is kind of an analysis. We do this quite a bit with clients, is looking at what is the travel, how often are they there for, and we can help kind of come up with some estimates of what that withholding would look like. And then they can set some policies around, okay, how many days are we comfortable with them going to another jurisdiction and working? And some states have exceptions, if you're only here for a trade show or, you know, or what have you, because they want trade shows in their state, right? So you'll kind of see these different incentives and benefits. But it really varies, but it's kind of a business decision on. But if they're traveling and moving quite a bit, again, that's where it's important to have your HR, you know, policies. If you're going to be anywhere for more than X number of dates or what have you, it needs to be approved, and we may withhold in these other states, and here's what that means for you. Kind of thing.
It's really dependent on the employee reporting.
It is, and ideally you have, and it's hard to track unless you have a software. Like I know for Baker Tilly, when we enter our time, you know, or many other payroll companies, right, that have a time entry system, you put the state that you're working in. So if you have a way for your employees to enter, you know, hey, I'm in Wisconsin for these days or whatever, then you can kind of offload that to your software. And, you know, your tax compliance work, right, and your payroll provider will say, hey, wait a minute, you had withholding because Bob was in Illinois for X number of days or what have you. You don't have an Illinois account. You know, they can typically still file and report that amount and then just put, you know, applied for, and then you would need to get registered to remit that withholding to the state. But unemployment would typically stay to where their base of operations is and where they're planning to come back to.
Is there a safe harbor of 30 days, something like that? I mean, if you're Kevin O'Leary, you can sue the states and create laws yourself, but
Yeah.
you know, for most people, you know, there's no safe harbor.
No.
Yeah.
There typically isn't. Some states will have a threshold of days. Once you're here X number of days or paid wages of, you know, in excess of, but unfortunately not. Yep.
Okay, well, thank you again so much.
Yeah.
We just should do this as an ongoing thing.
Sideshow, right?
Really, really. Thank you very much, everybody, for coming, and we'll see you at the next event.